Home values appreciated by 10% in 2020, and they're forecasted to appreciate nationally by 5% this year. And in Scottsdale, the prediction is 11%. This has some people voicing concern that we may be in another housing bubble like the one we experienced just a little over a decade ago. And in today's video, I'm going to share 3 reasons why this market is totally different. Hello, I'm Carol Bloom, a real estate relocation specialist with Move Us to Scottsdale and Keller Williams. I'm a licensed realtor both in Arizona and California. Let's get started. Number 1, this time housing supply is extremely limited. The price of any market item is determined by supply and demand. If supply is high and demand is low, prices normally decrease. If supply is low and demand is high, prices naturally increase. In real estate, supply and demand are measured in months' supply of inventory, which is based on the number of current homes for sale compared to the number of buyers in the market. The normal month's supply of inventory for the market is about 6 months. Anything above that defines a buyer's market, indicating prices will soften. Anything below that defines a seller's market, in which prices normally appreciate. Between 2006 and 2008, the month's supply of inventory increased from over 5 months to 11 months. The month's supply was over 7 months in 27 of those 36 months. Yet, those home values continued to rise. Months inventory has been under 5 months the last 3 years, under 3 months supply for the last 6 months, and currently stands at 1.9 months. It's an historic low since 1982. Remember, if supply is low and demand is high, naturally prices are going to be increased. Number 2, this time housing demand is real. During the housing boom in the mid-2000s, there was what Robert Shiller, a fellow at the Yale School of Management International Center of Finance, called irrational exuberance. The definition of the term is unfounded market optimism that lacks a real foundation of fundamental valuation, but instead rests on psychological factors without considering historic market trends. People got all caught up in this frenzy and bought houses based on unrealistic belief that the housing values would just continue to escalate. The mortgage industry fed into this craziness by making mortgages available to just about anyone that had a pulse. The higher the index, the easier it is to get a mortgage. The lower the index, the more difficult it is to obtain one. Prior to the housing boom, the index stood just below 400. In 2006, the index hit an all-time high, over 868. Again, just about anyone could get a mortgage. Today, the index stands at 122.5%, which is well below even the pre-boom levels. In the current real estate market, demand is real. It's not fabricated. Millennials, the largest generation in the country, have come of age to marry and have children, which are 2 major drivers for home ownership. The health crisis is also challenging every household to redefine the meaning of home and to reevaluate whether their current home meets that new definition. The desire to own, coupled with historically low mortgage rates, make purchasing a home today a strong, sound financial decision. Therefore, today's demand is very real. Remember, supply is low, demand is high, prices increase. Number 3, this time households have plenty of equity. Again, during the housing boom, it wasn't just buyers who got caught up in the frenzy. Existing homeowners started using their homes like an ATM machine. There was a wave of cash out refinances, which enabled homeowners to leverage the equity in their homes from 2005 to 2007. Americans pulled out $824 billion in equity that left many homeowners with little to no equity in their homes at a critical time. As prices began to drop, some homeowners found themselves in a negative equity situation where the mortgage was higher than the value of their home, and many defaulted on their payments, which led to an avalanche of foreclosures. Today, the banks and the American people have shown they learned a very valuable lesson from the housing crisis a little over a decade ago. Cash out refinance volume over the last 3 years was less than a third of what it was compared to 3 years leading up to the crash. This conservative approach has created levels of equity never seen before. According to the Census Bureau data, over 38% of owner-occupied housing is owned free and clear, without any mortgage. Also, Adam Data Solutions just released the fourth quarter 2020 U.S. Home Equity Report, which revealed if we combine the 38% of homes that are owned free and clear with the 18.7% of all the homes that have at least 50% equity, we realize that 56.7% of all homes in this country have a minimum of 50% equity. That's significantly better than the equity situation in 2008. So here's the bottom line. This time, housing supply is at an historic low. Demand is real and rightly motivated. Even if there were to be a drop in prices, homeowners have enough equity to be able to weather a dip in home values. This is nothing like 2008. In fact, it's the exact opposite. I hope this video sheds some light on why we are definitely not in a housing bubble. If you're looking for another video to watch on my channel, check out Should You Pay Over Asking Price? 5 ways to get your offer accepted. If you'd like to know more about Scottsdale, get a free copy of the Scottsdale Relocation Guide. It's full of information on neighborhoods and schools and entertainment and the outdoor lifestyle in the description box below. Thank you for watching this video. Please hit the like button. This tells YouTube to share my video to other people who, just like you, are deciding to make a move to Scottsdale. And I look forward to seeing you at the next video.